Hey guys, Joel Franklin, market analyst for YouTrading, and in today's video I'm going to be giving you a quick rundown about what's going on in markets at the moment. We're going to be taking a look at the economic calendar and talking about what themes could be driving markets this week as well. So let's jump straight into it. You can see here that US stocks, they're a little bit lower, about 0.8% lower, coming off these recent highs, still elevated compared to where we were a couple of weeks ago, and in mid-October, for example. But you can see here we've just slipped back below that 200-day moving average again. There's a bit of nervousness in the market um, that potentially this rally is getting a little bit ahead of itself. Yes, it looks like Fed hawkishness has peaked, but we're still talking about a Fed that's going to be tightening interest rates and potentially keeping them at elevated levels for quite some time next year. But we're also talking about a potential recession as well. Um, Although, let's just look at some data which has just come out. US ISM Services PMI 56.5, way or quite substantially stronger than expected. We're expecting a drop to 53.5 from 54.4. So basically, the US services sector is still humming along very nicely. If we just go back to last week, you can see though that the manufacturing sector in the US, when was it? It was last Thursday, right? Oh, yeah, there it is, last Thursday. 49.0. So in contractionary territory. So the US manufacturing sector doing badly, but services still humming along well. And just a quick reminder, strong jobs figures as well. 263,000 jobs added last month, 0.6% month over month wage growth. So, you know, how's the Fed seeing the US economy at the moment? Things are still pretty hot. Labour market's still strong, services sector still pumping. Yes, manufacturing is weakening a little bit, but it's still too early to be talking about a US recession. Even though people are talking about a US recession for next year, um, the Fed is definitely going to keep hiking interest rates for now. Yes, inflation's peaked, so they don't need to keep going in 75 basis point intervals. But to be talking about rate cuts or even a pause, that seems too soon. So a bit of profit taken there in US stocks. Cryptocurrency is also moving a little bit lower. If we just look at the dollar index, you can see that's rallying a little bit. It's been getting punished pretty badly in recent weeks. Um, whether the dollar index can get back above this 200-day moving average remains to be seen. Let's see how this Fed story shakes up in the next couple of weeks. Um, let me show you the calendar, and we can talk about some of the upcoming events that could shape markets this week. Pretty quiet for most of the week. You've got a couple of central banks that are important, like the RBA and Aussie GDP data, and then the BOC. That's they're both on Tuesday and Wednesday. Things start getting important again on Friday for me, anyway. So you've got core PPI ahead of the release of US CPI next. I believe that's next Tuesday. Yeah, next Tuesday. Obviously, inflation's still the most important data print at the moment. PPI, producer price inflation, it's not the main one that we watch. We watch the consumer one because that's the one that the Fed watches more closely. But still important to be keeping an eye on. And then this University of Michigan Consumer Sentiment Survey on Friday with the inflation expectations data as well. All of this data later this week could potentially be shaping that expectations for what the Fed's going to be doing in the next couple of months. And what markets really want to see is softening of inflation and softening of inflation expectations. And markets are in a bit of a mixed mindset about what they want to see with the economic data. So, for example, the reaction a little bit negative today in stocks and positive in the dollar. I mean, of course, it would be positive in the dollar, but negative in stocks to this strong services PMI. So that makes me think that uh, good data is bad data for risk assets because what markets want is bad data to encourage the Fed to be more dovish. So that's really what we need to be looking out for in the next couple of weeks. In terms of other asset classes, just a quick look at oil. Oil now able to hold above 80 for the last couple of days. Potentially the stage could be set for a grind higher, I'm thinking. This data out of the US has been pretty robust. China looks like they're going to be, or they look to be backing away pretty strongly from their zero COVID policy. The tone of the media there is talking about how much more mild the current strain of coronavirus that's spreading around China is. So they're sort of setting the stage for just leaving the zero COVID approach, which is good for the future of the Chinese economy, even if it does mean they're going to have a pretty swift spread and probably going to have quite a severe health crisis. But that could set the stage for a rebound in oil demand in China, which is supporting things for now. But then, the global growth outlook's still looking a bit bumpy. We're still talking about a recession for next year. So are we going to see a recovery back to these levels in the mid 90s? Remains to be seen. It's a possibility. But yeah, anyway, guys, that's pretty much what I'm keeping an eye on this week. Hope you all enjoyed the video, and I'll see you all in the next one.